Are you an investor with a rental property and you are looking to defer your capital gains tax? Well, we have the answer. Let's talk about a 1031 exchange. If you're new here, my name is Chris Payne at Keller Williams Realty. I make all these videos to help you make sense of the real estate market. If you would do me a huge favor, please click the subscribe button. Also, click that little bell so you can be notified every single time we drop fresh new content. And if you found value in this video, chances are someone else did too. So please go ahead and share it with them. Let's break it down very simply. A 1031 exchange is an investment opportunity for investors to sell their current rental property, take the proceeds from that property, and reinvest it into a like-kind property. Now, a 1031 exchange is an IRS tax code and used as the framework for this entire thing. So let's talk about what it is and how it can help you if you are an investor. Now, first of all, this works very well for seniors or children of seniors who are looking to help supplement their parents' income or actually increase their parents' income through this tax-deferred exchange. Now let's talk about key timeframes because those are the most important thing and the most important part of a 1031 exchange. So from the time that you sell your investment property, that's when the clock starts. The IRS is not going to let you hold onto the net proceeds of that property for very long. In fact, you don't actually get to hold onto the net proceeds. It has to go into what's called an accommodator account. So when the escrow closes, an accommodator is going to take those funds and hold those funds. Now they do that for a fee. It's approximately $1,000 on the sale of your property and another $250 to $400 on the purchase of your property. And then they will move those funds for you when you make the purchase. But the important thing to remember is that there is a time frame that is involved. So the first clock starts the day the escrow closes, and you have 45 days to identify up to 6 properties, and you have to keep track of those properties with the accommodator. Now, of those 6 properties, you can replace properties on there and you can actually change your mind up until the 45th day. But on day 45, of those 6 properties, you have to purchase 1. Now, the important thing to know here is you can purchase more than 1 property, and we'll talk about that, but it has to be equal to or greater than the value of the property that you just relinquished. Now, the entire exchange must be completed within 180 days. That means of those 6 properties, you must purchase and close on a new replacement property within 180 days. So there are 2 clocks that are kind of running simultaneously, and it's important to know that these clocks will run simultaneously. Now, I get a question, well, what happens if I haven't found a property that I like on day 45? Too bad, so sad. The IRS is going to instruct the accommodator to return your funds back to you, and you will pay capital gains on those proceeds. So that's why it's extremely important that you're working with a qualified realtor who is keeping track of those timeframes with you, and a qualified accommodator who holds those funds, because remember, you can't hold those funds until the purchase is made, and then the accommodator will wire the funds to the new escrow company on the purchase. Now, it's important to note here, if you only want to exchange a limited amount of funds, you can do that, and you can take some funds out. You can do pretty much whatever you want. You just have to meet the requirements, but there's more, so let's talk about that. Let's talk about like-kind property. Now, like-kind property, let's say you sell a 4-unit apartment complex here in North Park, for example, and you sell it for $1.4 million. That means you need to go and purchase like-kind property, something, an investment, for at least 1.4 or greater. But let's say you want to trade it up into a commercial apartment building. You can do that because it's like kind. So it's basically real estate for real estate. It just has to be like kind. So just remember, it's just got to be similar to the one that you just relinquished. Now, to fully defer the capital gains tax, and you need to talk to a qualified CPA about these things. I am not a CPA, and I'm not giving you any financial planning, tax, or legal advice, but in order to defer the capital gains, it has to be equal to or greater than in value. That's very, very important. You can't sell something for $1.4 million and then purchase something for $1 million, let's say. That's not the way it works. If you want to take advantage of the full deferment of the capital gain, it has to be equal to or greater than. Number 3, you have to use a qualified intermediary. If you need help finding a qualified intermediary, I've got a great guy that will help you do that. The qualified intermediary is the person that I mentioned at the top of this video, where they will take and hold your funds. So at the close of escrow, you go to sell your $1.4 million property in North Park. What the escrow company is going to do is they are going to give you a net sheet. That net sheet is then going to have a qualified intermediary that is going to hold the funds. The escrow officer is going to wire those funds into the intermediary's account. They're the ones that you're going to be reporting to with your 6 properties that you want to make a purchase on. Now, let's talk about for a second if you are a senior citizen and you want to bless your family, because I've had a lot of seniors who would like to do that. Let's say you have property that you would like to relinquish and you want to be able to help your kids and you want to make sure that there's no fighting upon your death. One way I've had some of my senior clients do this is sell their property. So let's say you go and you sell a $1.4 million property in North Park, and let's say it's completely paid off, and let's say also after the close you're going to net approximately $1.2 million, so that's $600,000 each. You can buy 2 properties, one with each of your children, and then they can be renting from you. So you are on title with your child, and upon your death, each child you put into a trust that they get that property. So that is the property that you are going to give them with the funds. It's just the total amount of the properties must exceed that $1.4 million. So let's say it's 1.8 million total. Then 1.8 divided by 2, there'd still be a mortgage. Your kids are going to be responsible for the mortgage. So these are all the things that you can do. You just have to identify up to 6. So you can buy more than one property. You don't have to buy just one, but you do need to make sure that it meets all the requirements, and a qualified intermediary can help you do that. Now let's talk about something called a DST, or a Delaware Statutory Trust. Let's say you want to get rid of the taxes, trash, tenants, and termites. A DST is something that you can buy into. Now, real estate agents cannot help you with the DST because it is governed by the IRS and the SEC, and so you absolutely must have a financial planner who has a Series 7 license that can help you get into a DST. But a DST also qualifies for a 1031 exchange. So let's say you go ahead and you sell that $1.4 million property and you want to purchase into a DST. What a DST essentially is you are buying a portion of, let's say, a shopping mall or an apartment building that's 400 units, or a building that holds a car dealership or CVS's that have 10, 12-year leases on the property. The downside to a DST is you are in it until the DST decides that it is going to sell the property, which can be anywhere from 7 to 12 years, and you don't get an option of buying out. It is a willable asset, so that way you can will it over to your heirs, but they cannot buy out of the DST. That way, every month you are collecting a check, and in some cases, it can increase your overall wealth if you do it that way. So for example, let's say you're making a 3% or a 4% cap rate on your rental income. Getting into a DST can increase that up to 8 or maybe 12%, because a lot of times people have really good tenants and they don't want to raise the rents. Well, if you don't want to do that and you'd feel guilty doing that, you can sell your property, let somebody else deal with that, and then go into this exchange into this DST. So if you need some help with that, I can help you sell the property and then recommend you to a qualified financial planner who can then help you move into the DST. So buying into a DST is exactly the same as selling a rental property and buying another rental property. Like I said, the only difference is you are not actually buying the full property, you're just buying a portion of it. Now, the one thing to keep in mind is you must be an accredited investor, and the financial planner will qualify you to see if you are an accredited investor. But essentially, being an accredited investor means that you have to have assets with at least $1 million. In this example, selling a property in North Park for $1.4 million that's already paid off, you would then become an accredited investor because you already have assets in excess of $1 million. Now, it is very, very important that you work with qualified people who know how to do 1031 exchanges. That means a qualified real estate agent that knows how to sell properties and help you find a replacement property. Here's the thing to keep in mind. You do not have to buy in the same city you are selling in, because it is an IRS tax code 1031. You can purchase anywhere in the United States. You do not have to buy in the same city or the same state as you sold your property in. So you can sell in California and buy in Arizona. It doesn't matter as long as it's in the United States. And it is also important to work with a qualified intermediary that knows exactly what they're doing, and if you choose to go into a DST, to work with that person that knows what they're doing and has the proper licensing. If you have any questions about getting into a 1031 exchange for retirement purposes, or you'd like to bless your family, feel free to reach out. I'd love to help you. I've also got great resources that we can tap into to make sure that it's done right. Thank you so much for watching, and I'll catch you on the next one.